So our first classification, ordinary assets. Remember, inventory, accounts receivable, trade or business assets that were held for less than 1 year. These are our ordinary assets. They're taxed at ordinary tax rates, ordinary income tax rates. And I mentioned here, when an asset is sold, the gain or loss that is produced is considered either ordinary or capital, one of those two. So ordinary gain or loss means it's going to be subject to ordinary tax rates. Capital gain or loss means it's going to be subject to capital tax rates, capital gain and gain tax rates. So when an ordinary asset is sold, the gain or loss is ordinary. Capital asset is sold, gain or loss is capital. When a 1231 asset is sold, remember that's that depreciable trade or business property, it could be one or the other. Okay, so it could be either ordinary or capital. So again, they talk about the capital gains tax rates, which are preferential. They're lower tax rates than ordinary tax rates. All right, so inventory sold, and I already kind of went through this. Inventory sold in the normal course of a trade or business generates sales revenue and would be taxed at ordinary tax rates. If we are selling inventory outside of the normal course of business, and it was held for less than 1 year, it's still going to be at ordinary tax rates. So here we've got Sheetal, sole proprietor who needs cash, decides to sell someone outstanding accounts receivable. They have a $10,000 fair market value and a zero basis. Zero basis because they've never generated income for them, therefore they never paid tax on any income. So that's why they have a zero basis. So she sold the receivables for $8,500. She's going to recognize an $8,500 ordinary gain on that. Then it will be at the ordinary tax rates. Sold some equipment for $22,000 on March 7th. It was originally purchased for $24,000 on April 8th, 2022, less than a year. Equipment was subject to depreciation of $8,640 for 2022 and 2023. Actually, technically speaking, you probably wouldn't even take depreciation on it in 2023, but because it was held for less than a year. But the adjusted basis is $15,360. The cost, what she paid for it, $24,000, minus the depreciation to get to the adjusted basis. She's going to recognize a $6,640 ordinary gain. Ordinary because it was less than a year. It was held for less than a year. All right, this is what the 4797 looks like. So part one, not really going to do anything with the top part here. Part one, sales or exchanges of property used in a trade or business. Most property held for more than 1 year. So first column here, what is the property description? When did you acquire it? When did you sell it? What was your sale price? How much depreciation did you take? And you notice here it says depreciation allowed or allowable. So even if you didn't take the depreciation, but you were entitled to, you still have to reduce the basis by that depreciation. So take the depreciation. Cost or other basis plus improvements, and then our gain or loss. So different properties there, list lines for different properties. Part two, ordinary gains and losses. So this is Sheetal. Remember, she sold the accounts receivable. This was outside of the normal course of business. If it was within the normal course of business, she's just going to report this on her Schedule C. But she sold these because she needed quick cash outside the normal course of her business. So she's going to report it here on the 4797. Part two, ordinary gains and losses. So again, same headings up here as down here. So the accounts receivable and the equipment, because the equipment was less than 1 year as well. Gains and losses, or what was paid, depreciation that was taken, what she paid for it, and then the gain. All of its total. So each of these lines, of course, you just want to go through and make sure that you add or subtract using the instructions there. So she's got a gain of $15,140 from the sale of both of those items. Enter here, and on Schedule 1, Part 1, Line 4. So it's going to get transferred to the Schedule 1 and be taxed at ordinary tax rates on that Schedule 1. I think you do have one of these to fill out in your tax return problem, if I remember properly. All right. Okay, so holding period, why is this here? All right, we'll go through this. I think this should be under the capital. Okay, well, for short or long-term assets, how do we determine it? If it's so this is for these are for capital assets, because obviously these are stocks or bonds would be capital assets. You're only going to hold them for investments. The holding period starts for determination of short or long term the day after the trading day that the taxpayer purchased the security. So if I buy something today, October 15th, my holding period is going to start tomorrow, October 16th, for purposes of determining whether or not it's been 1 year or more, or 1 year or less, or more than 1 year. Okay. For non-taxable exchanges, it's the day after the taxpayer acquired the old property. For gifts, the taxpayer's basis is the donor's basis. Holding period includes the donor's holding period. If the taxpayer's basis is the fair market value, the holding period starts the day after the date of the gift. You don't have to remember this stuff. This is just kind of FYI. I don't think you have questions surrounding this. Inherited property is considered to be held longer than 1 year, regardless of how long the property was actually held. That's really cool. So if you inherited grandma's house and she bought it a week before she passed away, it's still considered long-term property. Okay, it's always going to be, anything inherited is going to be considered long-term property. Real property purchase the day after the date the taxpayer received title to the property. Real property repossessed. The date the taxpayer originally received title to the property, not including the time between the original sale and the date of repossession. All right, fine. That is pretty obscure. Most of these are like the day after. All right. So, ordinary assets. Questions?